Hi guys, welcome to this Money Control live stream. You're watching Opening Bell right here with me, Nandita Khemka. It's a brand new week. We saw Freaky Friday, when we saw the Nifty plunge below that 24,900 mark. Today as well, looks like we are staring at a manic Monday, given the fact that the US jobs data that came out on Friday night, wasn't all that enthusing. We saw Wall Street clocking in its worst week since 2022. And of course, the tremors will be felt on the Lal Street today as well, with 24,800. That would be the crucial support level to watch out for the Nifty, and whether or not it can actually defend that crucial level or not will be in question. Lots of stocks in focus. We have the Bajaj housing IPO also opening up today. Of course, we'll be talking about all that, and we'll also be taking stock of all your stock related queries. So if you have any queries, keep them coming in on a live feed on YouTube, and we will try and take them up. Big Market Voice also lined up on the show, so don't go anywhere. We will be getting you a lot of opinion on how to really navigate this leg of the sell-off. But of course, before we move any further, let's take a look at the top headlines at this hour. Well, stock sell-off on Wall Street as a weak jobs report stokes fears of a slowdown in the US economy. The S&P 500 sheds over 4% last week, its worst week since 2023. The Nasdaq as well suffers its worst week since 2022. Asian markets, trending lower this morning. The Japanese Nikkei plunges over 3% following a weaker than expected GDP print, while the Hang Seng remains shut following a typhoon warning. The GIFT Nifty is also suggesting a lower start for the Indian market. Crude prices continue to tick lower. In fact, Brent trades around $72 a barrel mark on demand fears, even as OPEC delays its planned production hikes. Gold prices continue to trade above $2,500 an ounce. And the GST Council will meet today to deliberate on a number of issues, which may include imposition of GST on income earned by payment aggregators, changes in taxation on insurance premiums. The Council will also be taking up status updates on rate rationalization and real estate. Well, let's take a look at the cues for trade before we get on board our technical analyst for today. The S&P 500, as I mentioned, tumbled on Friday to post its worst week since 2023. The Nasdaq as well, drops 2%. But for the week, the Nasdaq was down somewhere around 6% or thereabouts. Worst week since 2022. Fresh August jobs data added fuel to concerns of slowing labor market. The US non-farm payrolls grew by 1,42,000 vis-a-vis expectations of 1,61,000. The unemployment rate, in fact, edged down to 4.2%, but that was largely in line with expectations. Where our markets are concerned, we did snap out of a 3-week gaining streak. Or on a weekly basis, all of the sectoral indices ended lower. PSU banks, they were the biggest laggards. They were down nearly 5. That index rather was down nearly 5%. And the energy pack was also down somewhere around 4% for the week. On Friday particularly, the market ended at its day's low below that 24,900 mark for the Nifty. Over a percent cut on both the Nifty and Sensex, and financials, of course, were the major drags. In fact, the Nifty PSU index was down by almost 4% on Friday itself. The BSE listed companies erased market cap of nearly 6 lakh crores on Friday. Looking at the options cues, the put call ratio plunged to below 1, 0.9 vis-a-vis 1.33 levels in the previous session. No new additions in the FNO ban list, but there are more than a couple of stocks that continue to remain in the FNO ban list, and they are the likes of Aditya Birla Fashion, Balrampur Chini, Bandhan Bank, Biocon, Chambal Fertilizer, Hindustan Copper, as well as RBL Bank. FIIs turned net sellers again after a few sessions of buying in the cash market, whereas domestic investors continue to be net buyers to the tune of 2,100 crore rupees. On that note, let's bring on board our technical expert for today. Joining me is Milan Vaishnav, who's the founder and technical analyst at ChartWizard. Milan, great to have you on the show here. 24,900, of course, has been taken out. 24,850, we were somewhere around that level, but 24,800, that's the crucial level that technical analysts are talking about, right? What is the probability of the index managing to defend that level today, given the fact that we have very weak or dismal global cues to really work with this morning?
Very good morning, Nandita. It's always A pleasure connecting with you all. See, I see number of things happening with the market, and let me first begin with a very short-term perspective. Let's talk about expiry that will happen on 12th September. So I'm taking a very short-term look, and going by that, I see that there is an incremental addition of the call OI above 25,000. I mean, between 25,000 and 25,200 levels. So that is the upper range that I'm seeing for the markets, if at all, as and when a technical rebound occurs. On the lower side, there has been significant addition of the put Y at 24,500, and more importantly, as of now, there is very little or near absence of any writing of calls below that level. So by and large, unless there is a major tactical shift that happens in the sentiment, I see Nifty staying in this defined range of 25,100 on the upper side and 24,500 on the lower. So now that is a very short-term perspective. Now let me zoom out a bit and talk about a little longer term perspective. Where I am concerned is the kind of deviation that we have seen on the charts. The Nifty as of now, the nearest 20-week moving average is almost around 4% below the Friday's close. And talking about the 50 DMA, even when a stock or an index tests the 50 DMA, the the main primary uptrend would still remain intact. But that 50-week moving average in Nifty's case is way below 9.5 to 10 odd percent. So there is a lot of deviation from the mean, and that has left some room for the markets to show some corrective retracement. So by and large, it's now become a kind of a sell on rally kind of a market where one would have to guard their profits at higher levels and shift to stocks that are showing some notable improvement and strengthening of the relative strength. That is what I would like to approach the markets like. Same thing with Nifty Bank. 50 DMA now remains an immediate resistance for Nifty Bank on closing basis, which is at around 51, 400, 500 odd levels. So by and large, I see the upside staying highly capped in this case.
Okay, but before we move on to some stocks that are in focus this morning, let's understand what you would be recommending for our viewers this morning, because you said that it's a sell on rally kind of a market, right? But any stocks that one should really pick, at any dip, would you be recommending any stocks, and which pockets would look interesting at this current juncture?
Yes, I would go in for that thing, but my view would be driven by extremely stock specific approach. The first buy I have is on PI Industries. One can buy about 46.10, expect the levels of 48.25 on the stock, and a stop loss of 4480 is recommended. The other stock that I'm looking at buying is Tata Tech, that is showing first signs after forming its listing highs. There's showing some first signs of a potential reversal in the trend. So I would recommend buying Tata Tech above 1110. Keep a target of 1200 on the stock and maintain a protective stop loss of 1055.
Okay, Tata Tech, that seems to be the recommendations coming in from Milan. But Milan, I think there is a sell call on Tata Tech from Citi this morning. We'll probably talk about it in a bit. But let's talk about the defensives, right? Because they are the ones that come to the rescue when the market really ends up seeing a big sell-off. That happened on election day as well, even during budget, and even now. Some of these pharma and FMCG names have been holding out, particularly for HUL. The stock has given positive returns on a week when the Nifty has, clocked in losses. There is some bit of news flow regarding this company. The company has constituted an independent committee to evaluate the way forward for its ice cream business. Of course, earlier, just a reminder, the parent company Unilever had stated that they are looking to separate their global ice cream business. In fact, ice cream business contributes less than 5% to HUL's total turnover. And in FY24, the turnover stood at somewhere around 59,500 crore rupees. Looking at the stock, would you really, advise traders to look at it as a trading play and make some, bucks out of it? perhaps buy on dips and sell on days when it sees some bit of up move? Do you think that should be the strategy here? Or should one look at it as a positional play and accumulate at every dip so that it offers some bit of support or comfort to portfolios?
I think I would go with the second option. I would take that stock in as a positional play because overall, Nifty FMCG index per se is inside the leading quadrant of the RRG, where it's showing constant improvement in its relative momentum against the broader markets. HUL has broken out from a small consolidation if we look at it from a short-term perspective, but on the higher time frame chart, that is weekly charts, it seemed breaking out of a Bollinger Band squeeze. So that can result into some sustained trending move on the stock. So long as it is about 2750 levels, I would recommend accumulating HUL with all declines.
Okay, those are the levels to watch out for, and perhaps levels where you can accumulate HUL. But one stock that's on my radar is Godfrey Phillips. It has seen great moves, right? In the last 1 month, the stock has rallied 60% or thereabouts. Of course, there is news flow that the company has reappointed Beena Modi as the managing director. In fact, 86.5 or 86.6% of shareholders voted in her support. How are the charts stacking up now? The kind of buying that we've seen in this counter, do you think it is at the threshold of entering into that overbought zone, or do you think the RSI is still hinting at more strength and there could be more upside going forward on this chart?
No, the thing is that looking at the Godfrey Phillips charts for short-term horizon, RSI is anyway overbought. Now, merely being overbought is not a reason enough to sell any stock. But if we take a holistic view on Godfrey Phillips from a technical perspective, I see that the stock is fairly overextended on the charts. That's my first concern. The second concern comes from the fact that on the daily time frame, there is a very evident negative divergence of the RSI that is showing up, that's building up. So maybe one can consider booking partial profits in Godfrey Phillips and trailing the stop loss effectively higher, so that as and when it gets triggered, we are left with at least 70% of the peak profits. That's what my approach towards the stock would be. So would be to book some partial profits and trail my stop loss higher in a way that the bulk of the gains stay protected.
Okay, hold that thought, Milan. We are, looking at market open at the current juncture, opening bell coming in. The first tick, of course, the Nifty has opened up on a negative note. That was widely expected. We are below that 24,800 level as we speak. The Sensex as well, it's a 200-point cut coming in, and looks like the weakness is only exacerbating from here. The mid-cap index is down somewhere around 0.4%. And the Bank Nifty also further away from that 50,500 mark. In fact, 50,400 is where it's at, and even there is a threat to this level as well. Let's take a look at what some of the other sectors are doing. Just want to see whether all the sectors are trading in the red, or do we have any sector that's managing to really hold out amid weakness. Yes, there is a sector, or there are a couple of sectors that are managing to hold out. FMCG being one of them. Of course, we were discussing HUL and FMCG just a few minutes ago. Continues to see buying interest in a weakish, environment. It's the defensives, as I mentioned, that comes to the rescue every time we see a sell-off. So, Nifty FMCG pack 0.3% higher. The Nifty Realty pack is also, managing to stand its ground. 0.2% kind of gains coming in there. But let's take a look at which is that sector that's really pulling the market down. Metals as a pocket, top loser, 0.7% lower for the Nifty metal pack. You have IT as well, 0.5% lower. Nifty infrastructure index is also 0.5% down. So aside of FMCG and realty, all the other sectors are trading in the red. Take note of the India VIX index as well, the volatility index, that's down or cooled off 7% at the start. Let's see how it pans out. In fact, as we speak, it's back up and it's above that 15 level, that crucial 15 level. So yes, volatility is or continues to be high. At a time when, of course, global headwinds are there, and we kind of react to that as well. FMCG pack gaining strength, 0.5% up now. Let's quickly take a look at the individual movers before we move on to more stock talk with Milan. In terms of gainers, we have Shriram Finance, Hindustan Unilever, SBI Life, HDFC Life, Britannia, TCS, Bajaj Auto. These are some of the movers. On the flip side, what's not doing well is ONGC, NTPC, Coal India, Tata Steel. So some of these metal names, as I mentioned, among the top laggards. Even ONGC, as I mentioned, from the energy pack in the red. Some of the private sector names like Axis Bank are under pressure, and even some cement names, Ultratech Cement, among the top losers. Looking at the open, Milan, we have broken below that. In fact, we are just about around that 24,800 mark. Of course, you mentioned that 24,500 will act as the crucial support for the index in the short term. But for the day, looking at the open, do you see the index, trying to make a recovery in the second half, or do you think the texture will be on the downside throughout the day? What's your feeling?
My reading would be that we can expect some rebound from lower levels in the second half of the day. Maybe going ahead, maybe in the late morning session and afternoon session onwards, some sort of technical rebound cannot be it cannot be ruled out, even if that remains a bit modest in nature.
Okay, expect some bit of recovery in the second half, but hold that thought, Milan. We'll talk about more stocks and we'll also talk about our viewer queries. But let me get on board our big market voice that I had promised at the start of the show. Joining me, Sunil Subramaniam, market expert, market veteran really, who doesn't know him. Sunil, great to have you on the show. After hitting record highs of over 25,000, we are back below that level, right? And given the kind of global news flow that's there, we have been fairly volatile. So how do you expect the next 3 to 4 weeks to pan out, given the fact that we have the crucial Fed meeting coming up next week, which could decide which way the markets will really swing?
So I do expect the markets to be reasonably volatile and be in a consolidation phase. The reason I should mention is the Fed Baitak, which is due, and the data that's so far coming is mixed. The non-farm payrolls number was below, and the September rate cut is more or less taken for granted, I think at 25 bips. But the 50 bips, which was hovering around the periphery, right, I think that's taken a slide. Maybe it's about 30 to 40% probability of that. So I think future direction will come from the Fed, not only on the September policy, but also on the commentary they talk about. I think increasingly the Fed is starting to say we will respect the market, which rather than saying we'll respect the data. So I think to some extent that's a good indication. But like I said, the US is heavily data dependent. And given that it's so on fine margins, so there will be an increased amount of volatility in the coming till the Fed actually spells out its stance. That's number one. Number two is domestically also, it's a crucial quarter in terms of the monsoon outlook with Ganesh Chaturthi starting, the festival season demand. So numbers will keep flowing in terms of the consumption numbers. So there'll be a lot of people waiting to see how that pans out. So a little bit of uncertainty in terms of actually committing capital flows, probably wait on the sideline. So I think this next few weeks will be, like I said, consolidation with a little bit of heightened volatility.
But would you say that the downside here on will be limited for Indian markets at least?
No, absolutely, because you have this strong domestic flows which are continuing to sustain at 23,000 crores of SIP book, and the fact that domestic fund managers are also, see, one of the things which is contributing to the volatility is the sector rotation, which is being largely done by the domestic fund managers. So what they're doing is they're taking profit of a lot of valuation high sectors, infra, energy, capital goods, PSUs, which had run up a lot. So rather than, not that they have a negative outlook towards those, they're just booking profits. And you can see that gentle shift towards defensives, right? You see IT, FMCG, those kind of a thing. And especially with government spending numbers, which have come through fairly positively. There's a lot of liquidity now coming back into the banking system with government spending post-election stepping up. So I think that domestic fund managers have cash. They are sitting on it. There will be some sector rotation, which means they could book profit and raise even more cash. And then, but the right stocks, they will come in and buy. So you're right that the downside I see as being limited, but all being said, with the sector rotation causing an increased volatility in the broader markets.
Right. Let's talk about banks then. That's one pocket that has been in focus because we've had quite a few brokerage reports coming out recently where they have turned cautious on this sector, especially the PSU lot, right? We've had a couple of brokerages trimming their target price for SBI at least below 800 rupees, and that's a big deal, right? So should one really stick to the large cap private names now, like how the brokerages have been pointing out, or do you think there is merit in staying invested in some of these PSU banks as well? Once the rate cut cycle kicks in, perhaps they could be beneficiaries. What are your thoughts?
So I would say that it depends on your time frame of investment outlook. If you have a 6 to 9 month time frame, then I agree with these brokerage houses that it's better to play the safer play of larger private versus the PSUs. Because remember, when I talked about profit booking, PSU banks were one of those which rose up sharply, and you can see a sharp narrowing of valuations between the public sector bank pack and the private sector because of the rally and the run up. So profit booking would happen there. Second is, like I said, with 6 to 9 months, I agree with their views for the reason that public sector banks, while they do have stronger CASA balances than the private sector, are more dependent on corporate lending to take their way forward, because the retail lending space is largely grabbed by the larger private sector banks and the larger good quality NBFCs, right? So when you then look at the corporate capex cycle, it's like the wolf story which never comes, right? There's been green shoots coming, but private sector capex, I think, has to see a clear, strong uptick for that private sector, public sector bank lending to start to pick up. The second is this news around the fact that deposit growth is much slower than credit growth, and the mutual fund industry and the stock market are being blamed because people are diverting their money away from the fixed interest rate banks to the equity markets. But that then causes a pressure, because until corporate borrowing picks up, the NIMs will be slightly under pressure, because when there's no corporate demand, it's hard. The typical demand supply, so it's a buyer's market. So the corporates today, if whoever wants to borrow is able to negotiate a price down, hence the NIMs in the short term in the pressure. But when capex picks up and then the orders start getting executed by the MSME sector, that's where the sweet spot is for public sector banks, because they are able to lend 100, 200, 500 crores to these mid corporates where private sector banks won't touch them. So, but if you have that longer term time frame, that one day corporate sector will pick up and these MSMEs will come to borrow, then I see the NIMs then actually getting strengthened, because there the bank is at the upper hand. So if you have an 18, 24 month view, I would say that, sticking to the public sector banks itself will deliver good rewards for you. But corporate oriented banks, whether they are private or public sector, would probably be that bet. So it's clearly a time frame related call. 6 to 9 months, stay safe. But if you are got a longer view and horizon, I would say that the broader corporate banking related banking sector, which PSU banks tend to be having a higher market share, would be a good place to continue to allocate.
What are your thoughts on NBFCs? Should one play the financial theme by NBFCs with a 6 to 9 month time horizon? What would you advise?
Yes, because I think with the festival season demand, retail EMI, zero EMI, and those kind of things will pick up. And I think that NBFCs also are always lesser NIM players, because they are step 2 degree away from banking, right? Many of them borrow from the bank. So what do the banks borrow? On top of it, they put on their margin, and then the NBFCs get access to capital at a slightly costlier. So they go down the cap curve. They spread their risks very well. They manage their operation very efficiently. So their fixed costs are very low. So the quick turnaround time and all of that, I think in the festival season when retail demand, and more importantly, it's important that the K-shaped recovery now flatten out to a more U or a V shape. That is the bottom of the pyramid. And that's where, I think NBFCs with their reach and quick turnaround could take the higher lead. So I agree with you that from a 6 to 9 month perspective, good quality NBFCs are probably a better bet to play the ongoing consumer discretionary story, which I expect with the festival season to kick off.
Right. IT is one pocket that you had mentioned. The IT pocket or IT pack has actually run up quite a bit, in anticipation of, a recovery in the discretionary demand environment in the US, of course, when the rate cut cycle starts. But do you think that the street has got overexcited ahead of time? Because, just reading a report from CLSA on IT this morning, and they've pointed out that the Nifty IT valuation, in fact, is just 7% away from the peak that was seen post-COVID, and it envisages, growth for Indian IT over FY26 to FY26 to 27 to be in high single digits rather than mid, teens in FY22. So, do you think, IT pack has gotten excited ahead of time, or do you think there are levers in place to still drive a double-digit kind of growth over the next financial year, next couple of financial years?
I would partly agree with this, because I think that getting back to COVID level valuations is definitely quite a strong uptick. But I would say that it's still not the end of the story, and I would still say there's juice left in. And the reason for that, I say, is that, see, a US rate cut cycle is going to be good for the banking sector there, the BFSI sector, right? And the BFSI sector is a big buyer of Indian IT products, right? So some of this optimism is coming from the fact that the BFSI space there, which has not been doing so well, with now the rate cut cycle coming and they're picking up, probably their IT paying could step up. That's one. The second aspect which the market is also factoring is that the Indian IT is also transforming itself by increasing use of AI and increasing use of this, so that more cutting edge IT related products, I think they are bringing to the table. I think though the growth may be high single digits, the change in the business mix augurs well for the future. The third aspect is that, see, IT as a sector, right? You look at it from the fact that I would put my head on the flows driving this pack. Now, what do I mean by that? Because a US rate cut cycle means that equity markets will get increasing flows. Increasing markets flows from international to India, a significant proportion is passives. And when passives come, they tend to put it right across the MSCI emerging markets pack, right, in MSCI India. And there you see IT is a significant weight. So regardless of what your actual numbers on EPS are going to say, money flow is going to come because they are a part of that index in significant proportion. Second is, even active allocators from FIIs, right, are willing to pay a premium for the certainty of growth. See, the cyclicality associated with energy, metals, and all of those places means that they are tactically in and tactically out, where you have to constantly manage. So IT, because of its sustainable revenue stream over a period of time, I think is something that will be a darling of the active allocators in a low interest rate, liquidity driven environment. So I would argue that there's still juice left in the IT pack for a further run up. And natural corollary to this is you will see that filter down the cap curve. So from the large cap oriented IT names, you'll then come look for good quality mid cap IT names and maybe some small cap too. So you'll get a broader rally in the IT across the cap curve, maybe not just limited at the top end of the curve. So I would say there's still juice left. It's still not the time to say that the top has happened.
Okay, that's the view then. But just one last question, in terms of investment into funds, right? Investors are almost spoiled for choice when it comes to thematic funds. They've gained so much popularity. So what should they keep in mind in the current market scenario when they are looking at investing into thematic funds, and which are the themes or which are the kind of funds they should be looking at within the thematic fund basket?
So I would say that they have over allocated to themes in the recent past. If you look at the more than a significant proportion of the flows have gone into thematic funds. Now, what has happened there is that what they've done is they've put it into themes which other AMCs have launched a year, 2 years ago, have done well, and hence they have chased those returns in choosing their themes, right? But right now, I think it's the time, I mentioned sector allocation, is to choose themes which have not maybe done superbly in the past, but if have a good tailwind to run in the future. So I would point out consumption as a good theme to put your money in. I would point out The banking and financial services, again, taking in mind the time frame approach that I had advised, that banking and financial services as a theme, I think it's an excellent play to allocate to. And I would also argue that to some extent, pharma, right, from a perspective of the fact that US is not likely to slip into a recession. And so if that growth, even though delayed, is going to ultimately happen, I think pharma will get its fair share of monetary allocations. So my recommendation at this point is to look at consumption, BFSI, and of course IT. IT, as I mentioned, I still feel there's some juice left in IT, so it's not bad to have these. So largely, it's a set of defensive set of themes. So I know that is a bit contra in opinion, because most teams sell when those teams have done superbly. Right? Take defense for example, energy for example, and all these thematic funds have been big hits in marketing perspective because the past returns are looking fantastic. I think it's time that people take a look at it and diversify. So having already invested in those kind of hot themes, choosing these themes with a longer term outlook would mean that overall they end up with a diversified thematic portfolio, which is the best for their long term returns.
Right. Well, those are the thematic funds and themes to really watch out for. With that, Mr. Subramaniam, I'm afraid we're running out of time. I would like to thank you for taking out time this morning and joining us and sharing your thoughts with us. Appreciate your, joining us. Of course, look forward to our next interaction as well.
Thank you. Thank you very much.
Well, with that, let's quickly go back to Milan then. He's been waiting by quite patiently. Milan, couple of queries coming in on HDFC Life. Holding out in a weak market. Of course, life insurance stocks will be in focus because of the all-important GST Council meet that's happening today. Of course, the Council will be deliberating on, taxation of insurance premiums as well. So we have queries coming in on our live feed on this particular stock. You can see Pankaj Kajalia wanting to know what to do with this stock. So SBI Life and HDFC Life, how would you really play these stocks if one has to look at it from a 1 to 2 days perspective, and even for the medium term, like 1 to 3 month perspective?
Okay, so let's begin with HDFC Life first. The stock is in a continued uptrend. I would continue riding the trend, but I would also raise my trailing stop loss higher to the low point of today. That is at around 734 is the low point approximately. So I would trail the stop loss higher to 730 and continue riding the up move. Any slippage below 730, regardless of the time horizon that I'm holding the stock, I would recommend booking profits in HDFC Life, but only if it slips below 730. So long as it is above this point, one can continue riding the trend. Coming to SBI Life, a similar view here on SBI Life. I would continue recommending holding the stock. It's in a very strong uptrend, but also protection of profits is equally important. So I would recommend trailing the stop loss higher to around 1880. So long as the stock is above 1880, one can continue to hold on to it. If it slips below this point, then I would recommend booking profits here.
Okay, that's the view on HDFC Life and SBI Life. But since we are talking about SBI Life, let's also talk about SBI Card. Saw a very strong up move on Friday in a weak market, a 5% uptick. Of course, that's on the back of an upgrade by Goldman Sachs. They've also hiked their target price to excess of to above rather 900 rupees from 652 rupees earlier, which was, I think, implying a over 20% upside going forward. The stock is quoting below 800 at the current juncture. But of course, it's still some time away from its 52-week high. Query on our feed, I can't really get the name of this person. SBI Card. Any thoughts? Have you turned bullish on this stock? And if yes, time to buy?
Yes, in fact, one must allow the stock to consolidate a bit, but it certainly qualifies to be bought at these levels as well as a bit lower levels as well if it consolidates. So SBI Cars has basically on the higher time frame charts have hinted at a potential beginning of an uptrend, and going ahead we can expect the targets of around 845 to 850 on the stocks. So yes, one can certainly enter at current levels, even at a bit lower levels if the stock consolidates. And for anyone who is continuing to hold the stock, may still continue to hold and expect 840 to 845, 850 levels over the next couple of weeks.
Okay, that's the view on SBI card. Hope that answers your query. The next one is coming in from Satya CK, a regular viewer. He has a query on CDSL and he wants to know your thoughts on the stock with a time horizon of 1 to 2 years. The stock has lost some mojo. If you look at the 5-day return, it's in negative. Even monthly returns of 7.5% are, isn't all that great. But on a 6-month basis, it has seen a good 50% uptick. Do you think there are signs of fatigue on the charts now? Because the good rally or the stupendous rally that it has seen over the last a few months, do you think that's kind of fizzling out now?
Yes, I see some clear signs of fatigue on the stock, and it has potentially marked a top for itself above 1600 levels. So I believe that he should stay put for a while, and if the stock slips further, I would advise him to exit. In event of any technical rebound happening along with the markets, he should use the higher levels to make an exit and re-enter the stock only above 1600 levels and not before that.
Hmm. Okay, that's the view on a CDSL. Hope that answers your query. Next query coming in from Kartikeya Singh, wants to know your thoughts on a Lupin. And he wants to know whether you would be placing higher targets on the stock. The stock is now at 2200. I think it's under pressure today because Citi has a sell call on this stock. What would your call be? Should one look at buying on dips? What's the strategy here, Lupin?
I think it's time that we book our profits on Lupin because the bulk of the up move over the past few weeks has come on negative divergence of the RSI, and that is a little bit uncomforting. And this is the first time in last couple of weeks, I must say that RSI is now slipped below 70 from the overbought situation. So by and large, I think at least 50% of the profits must be booked, and of the rest, they must trail the stop loss higher to 2100. Any slippage below 2100 would be a complete exit in the stock.
Hmm. Okay, that's the view. I also want to get in your thoughts on a SpiceJet, but before that, let's take up the query on IRDA. This one has come in from Srivardhan Gupta, wants to know your thoughts across all time frames on this particular stock. At one point in time, this stock was making higher highs, made good, up move since its listing. But over the last 1 month, it has, lost some bit of momentum. 8% lower in the on the 1 month chart, but I also want to see what it has done on a 3 month basis. On a 6 month basis, of course, it has seen good gains, but on a 3 month basis, the stock has still gained 25 to 26%. Is this a good opportunity to actually average it out now?
Yes, I think so because if you see on the overall chart, see, IREDA has basically a relatively short listing history. So if we, regardless of the time frame, we will get the same reading because uh, IREDA had a very strong breakout above 216 to 18 levels sometime in June this year, after which it went on to mark a high point of around 310, and from there it's been showing a retracement. Now that retracement is going back to the levels from where it broke out, so it's very near to that level from where it broke out, and that level also coincides with the 200 EMA, which is placed just below that point. So 2000, sorry, 212, excuse me, 212 to 216 is a very strong support zone for the stock. So one can certainly add in small quantities at current levels. However, a strict stop loss of 210 should be maintained on the stock. Otherwise, so long as it is beyond that level, that is 210, it certainly qualifies for a buy at these levels.
Okay, that's the view on IRIDA. The next query from Utsav Jain on PC Dwellers. The stock is shining bright. In fact, it has hit a fresh 52-week high in today's session. Utsav wants to know what's a good entry point for the short to medium term. The stock or jewelry stocks have seen, sparkling gains over the last month, even since budget. Do you think, people who are looking to enter have kind of missed the bus, or do you see more upside on charts and, every dip would present a buying opportunity now?
See, I will not say that they have missed the bus, but certainly they have missed the right moment to enter the stock. So far as PC Travel is concerned, it certainly remains a bit overextended on the charts, but that doesn't mean that it won't keep moving higher. For anyone who's looking at any fresh entry here can enter at current levels. However, they will need to maintain a very strict stop loss of 118 rupees on the stock because the fresh entry at this point in time is not coming with a favorable risk to reward ratio. So they will need to be very vigilant so far as triggering the stop loss levels concerned. A stop loss of 118 is advised here.
Okay, that's the view, that's the stop loss. Take note of that, and I hope that answers your query. The last query really for the day comes in from Abhishek Singha, wants to know your thoughts on a Suzlon, whether or not it's a buy at 70 rupees, at around 70 rupees for the next 1 year. The stock, of course, had lost some bit of sheen. At one point in time, there were predictions that it would hit 100 rupees, but it has been going downhill. But at 70, should it be looked upon as a buying candidate for the short to medium term?
No, I would not recommend a buy on Suzlon here because it is under a corrective retracement and there are no signs that this retracement will end. It may even drift lower towards the 50 DMA, which is placed at 67 rupees. So I think it should allow the stock to first consolidate, show some first signs of potential pullback, and then he can enter. So entering right now at this point in time is something I would not recommend.
Okay, that's the view on a Suzlon. Hope that answers your query. But with that, we've come to the end of the query segment. Milan would like to thank you as usual for taking out time and joining in this morning and sharing your thoughts with us, and also helping our viewers with their stock related queries. Look forward to seeing you again sometime next week.
Thank you very much. My pleasure.
Well, with that then, thank you. With that then, let's talk about, a big IPO that's opened up for subscription today. Bajaj Housing, the much awaited IPO, of course, opens for subscription today, closes on the 11th of September. The company is raising as much as 6,560 crore rupees through the issue. It has already raised somewhere around 1,700 crore rupees through the anchor book on Friday. And, marquee global names have participated, Government of Singapore, you have Abu Dhabi Investment Authority, you have Fidelity, Morgan Stanley, Nomura, Goldman Sachs, JP Morgan India, SBI Life. Among the domestic institutions, you have SBI Life, ICICI Pru Life, HDFC Mutual Funds, Kotak Mutual Fund, SBI Mutual Fund, a whole host of marquee domestic as well as global names have participated. The price band, 66 rupees to 70 rupees per share. And if you look at some of the brokerages as to what their, recommendation is, Anand Rathi has given a buy recommendation. In fact, even Incred Equities has recommended a subscribe rating. Of course, I will be getting you an exclusive interaction with the management at 11:30 a.m. So don't forget to tune in for that. But the other important cue for today would be the GST Council meeting that is slated for today. It will be chaired by Finance Minister Nirmala Sitharaman, and it is expected to deliberate on a host of issues, including taxation of insurance premiums, group of ministers' suggestions on rate rationalization, and a status report on online gaming as well. That's waiting by for a reprieve on the retrospective taxation. According to sources, all of these issues will be discussed. The Fitment Committee, comprising centre and state tax officials, will present a report on GST levied on life, health and reinsurance premiums as well, and the revenue implications. And the council, of course, chaired by FM Sitharaman and comprising state ministers, will decide on whether to reduce the tax burden on health insurance from the current 18% or exempt certain categories of individuals like senior citizens. Now, the deliberations will also happen about GST cut on life insurance premiums. And the panel may also deliberate on levying an 18% GST on payment gateway fees. Rate reduction for hybrid vehicles and inverted duty structure in textiles and pharma may also be on the agenda, according to sources. So this is one crucial meet that we really need to watch out for. In terms of the market now, just want to see what the broader markets are doing really, because the mid-cap index, as I mentioned, was in the red, but the bank Nifty has managed to bounce back and is now trading in the green as we speak. It has cleared that crucial 50,500 mark on the upside, and it's in fact above that 50,600 mark. Even the Sensex in fact has edged back into the green. So the opening lows have been curtailed as of now. The mid-cap index is down 0.4%, but the benchmarks have cut their losses. And what's helping indices stage a rebound is an up move in some of the private banking names, consumption names. Names like HUL, Tata Consumer, Asian Paints are among the top Nifty gainers, and even private banking names like ICICI Bank doing well, and life insurers in focus ahead of the all important GST meeting. Well, but with that, we are completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. Have a great trading day, and of course, join us at 11:30 a.m. when I get you an exclusive interaction with the management of Bajaj Housing. Thank you for watching, and stay tuned to Money Control for all your other news and updates. Goodbye from me.